And for what? So we can get 2% inflation? Why? Why two? We'll talk about why two, but let me get to this point. Reminder, inflation is by far the most lagging indicator of the business cycle. Anchoring quote unquote data dependent policy on future pending inflation data is a policy mistake. If you're anchoring your quote unquote data dependent policy on future values of the most lagging indicator of the business cycle, that is a policy mistake. I don't even care what the numbers are going to be. That you're already doing it wrong. You're driving backwards. You're on the it's like you're driving in the wrong direction on a one-way street. And fun fact, I was in probably middle school. There's a British lady who was driving down the wrong way on a one-way street in Seattle, and I literally had to jump out of the way before she hit me and landed on the sidewalk. And she was obviously mortified, and she didn't realize she was driving the wrong way down a one-way street. And Jay, you might be driving the wrong way down a one-way street. Please don't hit any kids. So for those who may not have been familiar with this analysis, this is probably the seminal conclusion from our business cycle. We did a deep dive study on the U.S. business cycle. So I'm not a big fan of academic economist theories and gobbledygook. I'd like to look at empirical data. If it's not observable in the data, then it doesn't exist, in my opinion. I don't believe in theories. I believe in empirics. And so we said, okay, well, how does the business cycle actually work? I don't care about the books tell me. What is actually occurred in the economy? And so we did a deep dive study to analyze hundreds of time series to identify, okay, how do they, which ones lead, which ones lag, which ones are coincident with the business cycle. And so the key takeaway, the main takeaway from that study, there's plenty of takeaways, but this is the big one, is that there is a pattern to which how the business cycle works. It's not, we don't just pop into an expansion or pop into a contraction. We don't go to recession. We don't go to recovery. We just, it's not random. There's a sequence to how the business cycle has historically worked. So what I'm showing here is the median trailing 10-year delta adjusted Z-score for each of these cycles that comprise the business cycle. There's a bunch of cycles within the economy that comprise the business cycle. And so essentially with that, that sounds mathy. What it essentially is the median path that each of these cycles takes into and through a recession. And so how the business cycles historically worked, and there's 12 post-war business cycles that represent the median for each of these cycles. So policy tends to get restrictive. It's called 15 to 18 months ahead of a recession. And corporate profits break down 12 months ahead of a recession. Then liquidity breaks down 3/4 ahead of a recession. And growth in stocks break down simultaneously 2/4 ahead of a recession. Then the unemployment rate breaks out right when the recession starts. So again, everything's delta adjusted. So down is bad for the business cycle, up is good. Unemployment rate breaks out right when the recession starts. That's when the NBER notice. That's when the baggy suit wearing economists notice, and they put the red bar on the chart after the fact. And then credit break, delinquencies, charge-offs break out quarter after the recession starts, and then inflation, the most lagging indicator of the business cycle, breaks down 12 to 15 months after a recession has already started. Jay, if you're waiting for inflation to break down, we will have gone through a recession already. Are you willing to are you willing to hit some kids driving down the wrong way on a street? Are you willing for you promised us pain in 2022? Are you willing? You want your legacy to be pushing the economy into a recession years after you let the inflation genie out of the bottle? Now you want to push us into the recession? Not then. It's just so stupid. Anyway, I'm glad you guys have fun with me. So the key takeaway is, inflation is not going to break down durably below the trend without a recession. Like, we're not going to get durable, sustained 2% inflation. The economy is going to stay above trend from an inflation perspective. We keep trying to break down. We tried to break down back in the middle of 2023. We tried to break down back in the middle of 2024. We tried to break down in the middle of 2025, but we can't do it. And the reason we're not doing it is because we haven't gone into a recession. You need the recession for people to stop raising prices. You need it. That is the signal for companies to stop pushing prices to the consumers. Demand needs to be destroyed. And so people like making money. So they're going to keep trying to make money until you tell them to stop, until the recession tells them to stop. Core PC deflators at 2 points popped up back to 2.6% on a 3-month annualized basis. That number's above trend. Oh, by the way, actually, I gotta make that part. I have so many points to make, but it's all on slide 64, so I'll save them. If you look at super core PC, which accelerated modestly to 1.8%. The number's still below trend. This is 2 consecutive months of below trend super core PC growth on a 3-month annualized basis. The first time we've had that in the time series since 2019. 2019, they cut interest rates 100 basis points last fall, and we did not even have this outcome. The last time we had this outcome in terms of 2 consecutive months of super core PCE inflation, which is the inflation statistic that Jerome himself in 2022 told us is the #1 inflation statistic the Fed has control over. This is now at its lowest level on a 2-month basis since 2019. And they cut 100 basis points last year. Now you have this outcome and you won't cut 25 basis points? I don't understand it. Doesn't it seem like there's a change in the reaction function from one administration to the next? It seems like it to me, because he had no problem taking the Fed's balance sheet 36% of GDP and keeping the policy rate 1,000 basis points below what the Taylor rule suggested in 2021 in the previous administration. Now he's the biggest hawk on the planet in the current administration. I don't get it. I don't get it. Why did the reaction function change? Why did it change? Someone tell me why it changed. Oh, that's right. It's because he let the inflation genie out of the bottle, and now he's trying to protect his legacy, so he goes out like a hawk. Underlying inflation is unlikely to return durably to trend without an actual recession. So we have not even sniffed breaking down below trend over the past several quarters in median PCE and trend mean PC deflator. We're at 3.4% and 2.8% on a 3-month annualized basis, respectively. And so part of the reason we can't break down below trend, and if you look at the glide path on inflation, like this is the year-over-year rate of change of inflation, the red line and the black line, 6-month annualized. Look at the glide path on inflation. Isn't that exactly what we've been telling you to expect based on this model here since January of 2022? We told you this is an economy that wants to have 3% inflation. If you look at all the factors in the economy, they're just the change in all these coincident and leading indicators of inflation and how they're performing in this model suggests that we should be having an equilibrium level of 2.9% core PC inflation, which is exactly what we've observed in the time series over the past few years. And again, we made that call in January of 2022. We finished bottom, and consensus was expecting this back to normal. We're not going back to normal until we go into recession. That's what the call we've been making since January 22, and I don't think we're going into recession. It's not, it's not real. We are the worst part of we're in, and will continue to be in the worst part of the U-shaped economy for the next, let's call it 6 months. And so if the Fed doesn't play ball, the markets will correct. If he says anything about tightening, the markets will crash. I don't think that's a high probability outcome. I think the Fed, Trump will nominate his replacement immediately that day. So the markets will immediately tune Powell out and start to price in whatever, Kevin Walsh or Kevin Hassett or whoever, maybe it's Secretary Best. Who knows? I don't know. We'll find out. But the key takeaway from this slide and the key takeaway from today's presentation is our secular inflation model continues to signal the equilibrium core PCE inflation rate is in the high 2s, low 3s. So equilibrium being the horizontal line in this, kind of stylized diagram. So inflation obviously goes up and down. What's the equilibrium level? Where's it going up and down from? So our model, that's for 3 years now, 3+ years, it's signaled that it's a kind of high 2s, low 3s type number. And so unless AI catalyzes a disinflationary productivity boom, of which it'll be somewhere close to 2. So the Fed's arbitrary 2% inflation target implies its policy setting is too tight for consumers and businesses on the bottom part of the K. We've been advocating for that. Obviously, the president is advocating for that. And so that's one of many reasons, not the most important reason, but it's one reason why we think Fed independence will get eroded over a long period of time, because the administration is trying to engineer an economic boom in paradigm C. And one way you can do that is to, obviously create more dovish monetary policy outcomes. But the most important reason why we think the Fed's independence will get eroded over time, much like we did from 1942 to 1951, when they yield curve control capped the short end rate at 37.5 basis points and the long end rate at 2.5% for 9 years. The last time we saw a significant erosion of Fed independence was in the previous four-turning. And we are currently in a geopolitically driven supply and demand imbalance in the current four-turning that will ultimately require an erosion of Fed independence to solve. They're not going to let the Treasury bond market blow up. They will lose independence to save the Treasury bond market, because guess what? The Fed works for us. Well, maybe it doesn't work for us as in, us regular people, but it is a function of the U.S. The Fed's not going to sit there and watch the United States economy just blow up because the bond market's blowing up. It's going to be forced into action. So just be aware of that. That's why KISS stocks go Bitcoin. So we're waiting at the finish line. But anyway, getting back into this, and I'll let you guys go. So how does this model work? This model interpolates the normalized change in these leading and coincident indicators of inflation upon the underlying unit root of the core PC inflation time series to figure out, okay, is the time series transposing higher or lower over time to be the equilibrium level. And so on an unweighted basis, and so actually let's just go down the features. So right now, if you look at AI, we proxy AI as NASDAQ 100 market cap as a share of Russell 2000 market cap. So what's the market cap of the companies most exposed to AI relative to the broad U.S. equity market? And that's currently 46%. And so that's applying a meaningful amount of disinflationary pressure upon the time series, upon the core PC time series. Automation, we proxy that as CapEx divided by employee compensation. So that's 27%. That's applying a modest amount of disinflationary pressure. Commodities, we proxy that by the CRB index. That's applying a modest amount of inflationary pressure. Deglobalization, we look at the imports of goods and services as a percent of GDP. The latest value is 14%. That's applying a modest amount of inflationary pressure. Demographics, the share of population that's 65 years and over, so people who are unlikely to work, exiting the labor force. Or sorry, obviously their demand curve is declining as well. So the latest value there is 17%. That's applying a modest amount of disinflationary pressure. The Fed reaction function, if we look at the Fed's balance sheet as a percent of GDP, that's 22%. That's applying a modest amount of inflationary pressure. The fiscal policy, if you look at the fiscal balance, the sovereign fiscal balance as a percent of GDP, the latest value is minus 6.3%. That's applying a modest amount of inflationary pressure. House prices, if we look at the FIFA house price index, the latest value on a year-over-year basis is 4%. That's essentially not applying any inflation or disinflationary pressure. Housing supply, if we look at household formation divided by existing home inventory, the latest value is 0.8 ratio. That's essentially a wash in terms of inflation. If we look at income inequality, the Gini coefficient is 0.49. That's applying a modest amount of inflationary, modest amount of disinflationary pressure. So you're essentially pricing out poor people from being able to buy stuff. That's why the electoral college map looked the way it did. Labor supply, labor force participation, that latest value is 62.2%. That's applying a modest amount of inflationary pressure. So we're losing labor supply. So obviously that's a positive influence on wages over the long term. Money supply growth, if you look at into on a year-over-year basis, the latest value is 4.5%. It's applying a modest amount of disinflationary pressure. If you look at money velocity, so M2 divided by nominal GDP, that latest value is 1.4 as a ratio. That's applying a modest amount of disinflationary pressure. If we look at monopsony power, so S&P 100 market cap divided by S&P 500 market cap, the latest value is 72%. So the top 100 companies in the S&P 500 represent 72% of the market cap. That's applying a meaningful amount of inflationary pressure. So essentially, the more monopsonies you have, the more pricing power they have. And the more pricing power they have, the more they can raise prices. And so that's adding a meaningful amount of inflationary pressure. We look at populism. So we look at the employment to population ratio of the 25 to 54, the prime working age population, employment to population ratio at 81% is applying a modest amount of disinflationary pressure. And so, as that goes up, you're essentially saying, as the employment population ratio goes down, you're going to get more populism. So it's going up. It's actually gone. It's actually, I think it's at an all-time high. So it's applying disinflationary pressure. Productivity, if you look at output per hour, so of non-farm, the productivity growth is 1.3% on a year-over-year basis. That's essentially a wash with regards to inflation. Public debt, if you look at federal debt held by the public as a percent of GDP, the latest value is 106%. That's applying a meaningful amount of inflationary pressure. You look at wages, the employment cost index, the latest value there is 3.6% year over year. That's applying a meaningful amount of inflationary pressure. And then the West Village Montauk effect. For those who may be new, the West Village Montauk effect is a phenomenon that we identified in the economy back in 2023 to support our resilient U.S. economy. Well, we identified it and recognized that it would support our resilient U.S. economy theme and has for a long period of time. And so what the West Village Montauk effect is essentially we have such a high stock of savings on the household sector balance sheets as a function of the historic fiscal and monetary largesse we've seen since COVID. The checkable deposits and currency as a percent of total household assets is now 3% of total household assets. It's the highest percentage we've ever seen in the time series, data going all the way back to the 50s. That's applying the most amount of inflationary pressure. And the reason why is because we have all this cash sloshing around in people's checking accounts that can go be spent into the economy at any given time. So this is part of the reason why the economy's been resilient. And the origin of this, the reason I was able to notice this, and without a academic economist, PhD, the econs of the Fed don't even realize this, but the reason I was able to notice this is because I'm someone who spent a lot of time partying in West Village and Montauk, and you realize that the people who spend the most money in these places at Surf Lodge and Common Ground, the people who spend the most money aren't the richest people. It's the people whose mom and dads are the richest, because they can spend a higher share of their income into the economy week after week, month after month. If your mom and daddy already saved all the money that you're going to need to retire with, you can take 100% of your Wall Street analyst or associate income and spend it on bottle service. But people like me who have to, send money back home and actually grow a nest egg for my family, I can't spend all my money on bottle service because I actually have to save money. And so the reverse of that is true as well. Is if you already have a bunch of money in the bank, you don't need to keep saving money. And so that's why the savings rate has been structurally depressed throughout this entire business cycle. That's why consumer spending has been relatively resilient throughout this business cycle, because they're relatively resilient, certainly relative to the elevated policy rate. And that's because we have all these savings on household sector balance sheets. Now, it's obviously not evenly distributed. It's obviously we have a big K-shaped economy, and the top part of the K, if you look at the upper median, the top third of consumers account for 51% of consumer spending, whereas the bottom third of consumers only account for 15% of consumer spending. So, it's a very unevenly distributed K, but the reality is that was all contributing to the resiliency of the economy. But this is contributing to a high level of inflation. And so the key takeaway is that this is an economy based on all these factors. I've been talking for 10 minutes here. All these factors, the economy just kind of wants to have high twos, low threes inflation. But the Fed has this arbitrary 2% inflation target that it got from some dead central banker in New Zealand. And so, of course, they're going to run monetary policy too tight, because they're trying to get to a level of inflation that is, quite frankly, asinine in the context of everything I've been talking about. And so, and the only way you can really win here is if you're the Federal Reserve. They can get lucky on the productivity boom, because what I did in the model was I said, okay, on the unweighted model, weight all the factors evenly, the economy wants to have 2.9% core PC inflation on an equilibrium basis. But if we weight AI for 50% of the weight and then give all the remainder, the residual, to all the other factors on an equal basis, so AI is now 50% of the model, that's how you get to an equilibrium core PC inflation level of 2%. So we literally have to have a disinflationary productivity boom for the inflation to durably rest at the Fed's 2% target without a recession. So if that's the outcome they're betting on, they're going to make a policy mistake, because otherwise, this is why I've been saying, you've got to let they got to change the inflation target. The inflation target has to be 3. If you keep it at 2, it's going to create negative outcomes. That's part of the reason why we have a K-shaped economy. And, oh, by the way, everybody that goes, Darius, if they revise the inflation target to 3%, won't that destroy the bond market? And I'll say the exact same thing to you that Mariner Eccles and Thomas McCabe said to the bond vigilantes back then, which is, nope, you're going out of business. I'm going to buy every bond in sight that's above 2.5% yield, which is what they did for 9 years. The Fed could easily say, we're going to cap the 10-year treasury yield at 3.5%, and every bond on earth that's trading above 3.5% is going to be bought and sold to the Fed. You don't think there's going to, I will start a hedge fund to buy every treasury on earth to sell to the Fed if they're going to cap yields at some point, which is exactly where I think we're headed over the long term. It may not get there over the next few weeks or months or the next couple of years, but that's where we're headed by the end of this fourth turning poly crisis. I guarantee it. So we'll wrap it up there. Darius Dale here presenting our Round the Horn for Saturday, August 2nd, 2025. Best of luck out there. Actually, have a great weekend. Remember, if we're starting to correct, just think about this shirt. Go to the beach. We're still in paradigm C. Unless you hear me say we're going back to paradigm B, you got to assume the dip will be bought. And so we'll catch you back here next week. Have a great weekend.